Welcome to this video. Today, we're talking about one of the most important indicators for evaluating stock markets, the so-called Buffett Indicator. Named after the legendary investor Warren Buffett, this indicator is often seen as an early warning system for market overvaluation. Stay tuned to learn how this indicator works, what role it plays today, and what it can tell us about the current state of the markets. What is the Buffett Indicator? The Buffett Indicator shows the ratio of the total market capitalization of stock markets to the gross domestic product, or GDP, of a country. In the United States, the Wilshire 5000 Index is mainly used for this purpose, as it includes almost all stocks traded in the U.S. This means it gives us a comprehensive overview of the size of the stock market in relation to the economic power of the country. A high value of the Buffett Indicator means that the stock markets are extremely highly valued compared to the economic power of the country. But why is this important? If valuations are very high, as we currently see, it could indicate that the market is overvalued and that a correction or even a downturn may be imminent. Historical examples and warning signals. The Buffett Indicator can serve as a long-term early warning system. In the past, it has been shown that after a peak in the Buffett Indicator, it took 6 to 24 months for a recession to occur. One example of this is the dot-com bubble. At that time, the Buffett Indicator reached over 140%, which meant that the stock market was valued 40% higher than GDP. After about 18 months, the crash occurred. A similar pattern was also seen before the 2008 financial crisis. According to FinanceRadar.de and longtermtrends.net, the indicator was also an important signal during the 2008 financial crisis, which many investors ignored. At that time, the markets were characterized by high debt and significant leverage, and the Buffett Indicator showed a high risk. Investor psychology. Another interesting aspect of the Buffett Indicator is that it also tells us something about investor confidence. When market capitalization is extremely high relative to GDP, it suggests that investors are very optimistic about future economic growth and corporate earnings. However, this confidence can be misleading, especially if economic fundamentals do not actually support this growth. According to valueinvesting.de and other sources, external factors such as low interest rates, a high level of liquidity, and the expansionary monetary policy of central banks can boost investor confidence and make markets appear overvalued. Application of the Buffett Indicator in modern times. In today's world, where we are dealing with high inflation rates, geopolitical uncertainties, and other economic challenges, the Buffett Indicator plays an even more significant role. Many investors are looking for clues as to whether the market is overheated or whether there is still room for further growth. The Buffett Indicator serves as a useful point of reference, but it should never be viewed in isolation. Other factors, such as central bank interest rate policy and fiscal measures, also play a significant role. Critical consideration and use by investors. For investors, it is important to consider the Buffett Indicator in combination with other indicators. Examples include the price-to-earnings, PE ratio, dividend yield, or macroeconomic data such as the unemployment rate and interest levels. Corporate balance sheets and the debt situation of companies should also be taken into account to get a complete picture. Valueinvesting.de points out that the Buffett Indicator should mainly be used as a rough measure of overall market valuation. In conclusion, the Buffett Indicator is a useful tool for assessing the overall valuation of the stock market and identifying potential overvaluations early. However, it is not a crystal ball that can give us precise predictions about the timing of a correction. Therefore, investors should always conduct a comprehensive analysis of various economic and market-related factors. Sources like Current Market Valuation Value, Investing.de, longtermtrends.net, and FinanceRadar.de show that the Buffett Indicator is a valuable tool, but it should always be viewed in the context of other factors, and in conjunction with other indicators. If you enjoyed the video, give us a thumbs up and subscribe to the channel so you don't miss any updates. Feel free to leave a comment below on what you think of the Buffett Indicator and whether you use it as a basis for your own decisions. Thanks for watching, and see you next time.